Hello everybody, it's Stuart Heath here, CEO and founder of Harvard Grace Capital with part 8 of our series, Important Investing Terms That You Should Know. The deeper we get into the series, the more technical the terms, and I'm betting fewer and fewer people know what these terms mean. This week we're talking about some investing terms: prospectus, alpha, beta, blue chip, and bubble. So let's just dive right in. What is a prospectus? Well, when a company decides to raise capital, either in debt capital or equity capital, and they want to do that publicly, they're required to produce a prospectus, which tells the potential investor everything they need to know about the potential investment. What are all the risks? What are the potential rewards? Here are the historical financial statements. Here's the management team. It's a bit of a business plan with a whole lot of legalese and things like that thrown in. It just occurs to me, wouldn't it be great if we could get political candidates to do that? So that's what a prospectus is. It's really nothing more than a data dump, if you would, a book that tells you everything you want to know about the potential company that you're looking at investing in. What's a blue chip? Well, a blue chip stock is generally thought to be a stable stock that's been around for years and years. They have very little volatility. They're solid and, like I say, stabilized companies. They tend to hold their value. They'll go up. They'll grow a reasonable rate every year. Usually will pay a dividend. So you don't hear a whole lot about these. They tend to be rather boring stocks. You hear more about the high-flying stocks these days, such as the Magnificent Seven, things like that. Before we get to alpha beta, I'm going to cover a bubble. A bubble in any market, and if you go through history, there have been many bubbles in markets, especially the real estate market. But you can also have a bubble in the stock market or the bond market. A bubble is thought to be an artificial inflation of the values of the underlying securities in that particular sector. And then it will pop, which is why it's called a bubble, and then everything will tumble back down, usually overcorrect before they come back to what the market identifies as a regular value. A lot of times you'll hear this in real estate. It happened back in 2008, 2009. Everything was just up and up and up and up and up, and then the credit crisis happened. And if you remove credit from the ability to buy real estate and stocks, asset prices will fall. So that was a bubble back then. What is alpha and beta? Well, they're the first two letters of the Greek alphabet. And at some point in the past, some pretty smart guys, in trying to define the science of determining value and investing strategy, they labeled alpha, which alpha is essentially the term that they have given to a strategy to beat the market. So if you think of the market as the S&P 500 or just the general stock market as a whole, your strategy, seeking alpha, is your strategy where you're going to beat the standard, if you would. Beta is a little bit of the opposite. Beta is a term that refers to the volatility of a stock, a plan, or an industry, and it is generally expressed as an integer. If the S&P 500 has a beta of 1.0, then a strategy or a stock or a sector that has a beta higher than 1 is thought to be more volatile, more risky than the benchmark standard. Likewise, if it's below 1, you're less volatile, less risky than the market in that case. Hey, get the book, download it from our website, find the official definitions. Would love to hear from you. Thanks for watching.